This video provides the tax introduction to this module and discusses the age-old academic question, what is a tax? I'm sure you've all been waiting your entire lives to find out. But before we answer that question, I'd like to cover the learning objectives for this module. These are also provided on the Module 1 page in Blackboard. As I previously mentioned, you'll finally know the answer to the question, what is a tax? We'll discuss the different types of taxes and how the world has been carved up in a geopolitical fashion, permitting the tax jurisdictions to appear. I'll show you where the tax law is derived so you can learn to investigate tax issues for yourself. It's my hope to convince you that there is such thing as a good tax and what that might mean. We'll discuss the various types of tax rates that we use and the different purposes. We're also going to discuss the fundamental goal of tax planning, maximizing the present value of after-tax cash flows. Then we'll discuss some of the uncertainties that life throws our way to make tax planning more difficult. And lastly, in this module, we're going to talk about how markets can affect taxes. And again, that's for the whole module and not just for this video. So what is a tax? Well, the academic definition is a compulsory payment to support the cost of government. That definition has three key concepts. Number one, it's mandatory. Number two, it's paid to the government. And number three, the payment supports the cost of government, and the taxpayer receives no direct benefit for that payment. The closest thing to a tax is probably a fee, but typically a fee does provide a direct benefit. For example, a fishing license is a fee because it provides the direct benefit of the ability to fish legally. I've always viewed the definition of a tax as a purely academic exercise. Governments routinely call fees taxes and call taxes fees. In fact, the Affordable Care Act, or Obamacare, implemented such a payment for those that didn't have health care insurance. The law called it the individual shared responsibility payment. The U.S. Supreme Court called it a tax. Okay, the next definition is reasonably intuitive. What is a taxpayer? That's the entity or person that pays the tax. Because of compliance issues, that is a very important definition, but it does not capture the economics of a tax. For that, we use the term incidence. Incidence refers to who bears the burden of the tax, and that is not always the same as the person that pays it. If Simon Cowell works and generates wages for which he owes income tax, he is both the taxpayer and he bears the incidence of that tax. However, if Simon purchases an article of clothing and pays sales tax, even though the store is the taxpayer, they remit the sales tax to the government, it's Simon that bears the incidence of that tax. But incidence is not always as straightforward as it seems. The sales tax is typically thought of as just in Simon's case. The customer bears the burden, but the retailer is the taxpayer. However, we need to look more closely. This example has to do with a hotel or occupancy tax. Hotel taxes are very popular in tourist areas, and so in this example, we're going to look at hotel taxes in Florida. The state has a hotel tax, but also allows counties to assess a separate and additional hotel tax. Because Disney World is in Orlando and is such a popular destination, it should come as no surprise that the counties near Disney impose a hotel tax. Near Orlando are two counties that impose differing hotel taxes. Osceola County charges a 13% tax, and Lake County charges an 11% tax. In our hypothetical example, these two hotels, although in different counties, are identical in every other way, and both charge $100 per room per night. After considering the hotel tax, a hotel room in Osceola costs $113, and the Lake County hotel will cost $111. Since these two hotels are identical in every way, what hotel will tourists select? Over time, more will select the cheaper alternative in Lake County and save the $2 each night. As the Osceola Hotel watches its paying guests flock to the other hotel, it's going to have no choice but to lower its price for the room. In fact, in order to charge the same $111, including tax, the hotel in Osceola will be able to charge only $98.23, thus reducing the profit on the room by $1.77. Now, we need to pause a moment and consider, who is the taxpayer? Well, that's still the hotel. They're still the one paying the tax. However, who bears the burden? Because Hotel 1 and Hotel 2 are perfect substitutes for one another, part of the burden of that tax is shifted to the Osceola Hotel so it can continue to operate. In economics, we call that elasticity, and it applies to taxes as it might for other prices. In this case, the Osceola Hotel is unable to shift the burden of that tax to the guest, and therefore retains that burden. Understanding who bears the incidence of a tax is critical to understanding tax policy in general. Okay, let's look at another example where the taxpayer and the incidence may not be the same entity. For those of you that worked, you know that a certain amount of your pay is withheld to pay Social Security, Medicare, or as some call it, FICA taxes. The way FICA taxes work, and don't worry, we're going to cover employment taxes in greater detail later, is that one half is paid by the employee through withholding from their pay. The other half is paid by the employer. So on its surface, the employer is the taxpayer and bears one half of the tax, while the employee bears the other half. But who do you suppose actually bears the burden or incidence of employment taxes? Well, most employers are not naive and consider the total cost of an employee when deciding how much to pay that employee. Let's say you are worth $10 an hour. From the employer's perspective, you don't cost $10 an hour, you cost $10.76 per hour, after including the cost of their half of the employment taxes. As such, they no longer are going to offer you $10, but rather they offer you about $9.30 an hour, ignoring minimum wage, so that your total cost is $10. Most research shows that the burden of both halves of the employment tax is actually borne all by the employee and none by the employer. How can you shift your burden to the employer? Have no substitutes. Okay, getting back to our definitions. Jurisdiction refers to the right of a government to tax an entity. Like our hotels, Osceola County taxed the Osceola Hotel, while Lake County taxed the Lake County Hotel. Osceola was not permitted to cross county lines and tax the Lake County Hotel. They had no jurisdiction. The U.S. taxes its citizens and tax residents on their worldwide income. Thus, the U.S. taxes any citizen on income that is earned anywhere on earth. However, a citizen of Spain that has no connection with the U.S. cannot be taxed on their income by the U.S. Of course, Spain is likely to have a go on their own. To calculate taxes, we use the basic tax formula. Tax equals rate times base. Rate is often defined as a percentage of the base, and the base is what we measure and is typically in dollars. For example, taxable income is the tax base for the income tax. Property value is the tax base for a property tax. Revenue is the term we use for taxes from the government's perspective. Taxes are one, and often the primary, form of generating revenue for the government's use. When the government wants to increase revenue, they can either increase the rate or increase the base. For example, when the Trump administration calls for a decrease in rates, but the elimination of deductions, they're decreasing the rate but increasing the base. Whether that increases, decreases, or keeps revenues the same is a matter of economic estimation. When we think about tax rates, they can be characterized as flat or graduated. For example, most sales taxes are flat. We all pay at the same rate, at least within a jurisdiction. Graduated rates mean that different levels of base pay a different rate. For example, the U.S. income tax has graduated rates. As income increases, the rate increases as well. We're going to discuss rates at length later on. These other definitions are pretty self-explanatory. Okay, that brings us to the end of this video. In the next video, we'll discuss different types of taxes. Thanks for watching.